Okay, so you think BlackRock is a giant fund that picks stocks for you, and somewhere in a boardroom, an army of analysts decides where your money goes, while BlackRock takes a cut for its wisdom. Except look at what happens when you buy BlackRock's single most popular product, an exchange-traded fund called IVV, which simply tracks the S&P 500. The annual fee is 0.03%. Put $10,000 in, and BlackRock earns about $3 a year. But that number should stop you. $3. And yet, in the second quarter of 2026 alone, BlackRock reported $7 billion in revenue while managing $15.3 trillion. More money than the yearly economic output of every country on Earth except the United States and China. If the fee on the flagship product is close to nothing, what is BlackRock actually selling? Here's the real answer. BlackRock isn't primarily in the business of picking winners. It's in the business of being the infrastructure other people's money runs on. And it charges almost nothing for the money management because the real profit sits one layer underneath, in the software, the scale, and increasingly the physical assets that scale lets it buy. Index investing turned stock picking into a commodity. BlackRock's answer wasn't to fight that, it was to own the pipes the commodity flows through. To see why BlackRock built it that way, go back to 1986, inside a bond trading desk at the investment bank First Boston. A young trader named Larry Fink had helped pioneer a new kind of security, built by bundling thousands of home mortgages together and selling slices of the bundle to investors. Fink's desk was good at building these instruments. It was worse at knowing exactly how much risk sat inside them. When interest rates moved in a direction his models hadn't priced in, his department lost about $100 million in a matter of months. Fink Vader called it the moment he screwed up. The damage wasn't only financial, it ended his path at the firm. That failure became the founding idea of an entire company. In 1988, Fink and 7 partners, several of whom had worked beside him at First Boston, pitched a different kind of asset manager to the private equity firm Blackstone. Blackstone put up $5 million for half the new company. The pitch wasn't better stock picking, it was better risk measurement, built into the plumbing from day one. Within 35 days, the new firm signed its first client. Within 4 months, it was profitable. Within 6 months, by Fink's own account, they no longer needed Blackstone's money at all. The firm eventually took the name BlackRock and went public in 1999. By the end of 2024, it employed roughly 21,000 people in more than 30 countries, serving clients in more than 100 countries, an operating footprint most banks would envy. The tool the founders built to measure that original risk, an internal system that first ran on a single workstation, would later be named Aladdin. Nobody planned for it to become a business on its own. In 1999, another financial institution learned BlackRock had built this internal risk engine and simply asked to license it. That accidental sale created a second company hiding inside the first one, and it explains the 2-layer structure underneath everything BlackRock does today. Layer 1 is money management, the part everyone assumes is the whole business. Layer 2 is technology, the part almost nobody outside finance has heard of. BlackRock kept extending that second layer for decades after the fact, buying a firm called eFront in 2019 specifically to bring the same kind of risk software to private, hard-to-value assets, years before private markets became the company's next stated priority. The software came first. The strategy caught up to it later.
Start with Layer 1 and run the actual transaction. Say you put $10,000 into IVV. BlackRock doesn't own your money, and it never touches it. Legally, the shares of Apple and Nvidia and every other company inside that fund belong to you, held in a structure BlackRock merely administers. What BlackRock sells is the administration, buying and rebalancing the basket, licensing the S&P 500 index itself, handling the paperwork, and running the trading infrastructure that keeps the fund's price matched to its holdings all day, every trading day. For that, it charges 3 cents on every $100 a year, a fee that fund data trackers put at roughly 93% below the average expense ratio on comparable large company stock funds as of mid-2026. That gap is not an accident. A traditional, actively managed fund pays analysts to try to beat the market and prices that effort into the fee. BlackRock's index funds don't make that promise, so they don't charge for it. The only way 3 cents on every $100 turns into $7 billion in a quarter is volume. BlackRock is pricing a utility, the way a water company prices water, and it wins by owning the largest pipe network on Earth. That system also generates a second, quieter stream of income. Inside many of these funds, BlackRock lends the actual shares it holds to other investors, often short sellers who want to bet against a stock, in exchange for collateral and a fee. Most of that fee flows back into the fund itself, boosting the return you see, while BlackRock keeps a slice for arranging it. It is a low-risk toll charged on assets that are already sitting there anyway. $15.3 trillion flowing through a fee structure this thin still adds up to real money, but not enough on its own to explain BlackRock's profits. That's where Layer 2 comes back in. That internal risk system from 1988 is now called Aladdin, and it does something almost nobody expects. BlackRock rents it to its own competitors. Banks, insurers, pension funds, and even central banks pay BlackRock a subscription to run their portfolios on the same software BlackRock uses to run its own. As of recent reporting, Aladdin oversees more money for outside clients than BlackRock manages itself. Well over $20 trillion flowing through a platform BlackRock built to solve its own 1986 problem. Industry reporting has put Aladdin's licensing revenue from those outside clients at somewhere around $1.5 billion a year. The exact figure matters less than what it reveals. A rival asset manager can undercut BlackRock's fees, and some do, but that rival might still be paying BlackRock a subscription just to see its own risk exposure clearly. BlackRock doesn't need to win every client's money. It only needs to win the software the money runs on. Stack the two layers together, and BlackRock's revenue stops looking like one thing and starts looking like an architecture. Base fees and securities lending, the Layer 1 business, brought in $5.7 billion in the second quarter of 2026 alone. Technology and subscription revenue, Layer 2, grew at a similar pace that quarter, and unlike a fee percentage, a subscription doesn't erode when a competitor undercuts you on price. Add performance fees on the funds that beat their benchmarks, advisory fees for managing other institutions' balance sheets, and distribution fees paid by the banks and brokers that sell BlackRock funds to their own customers, and a company that looks from the outside like it sells one thing, a fund, is actually running several businesses layered on top of the same $15 trillion base.
That base is also unusually diversified by who supplies it. BlackRock's money comes from retail savers buying ETFs and a brokerage app, but just as much comes from pension funds, sovereign wealth funds, insurers, and corporations parking cash, spread across client types and regions so that a slowdown in any single country or investor category rarely dents the whole. Scale, in other words, isn't just a number. It's a form of diversification that a smaller, more regionally concentrated rival simply cannot replicate. If you're getting something useful from this so far, a like and a subscribe help keep these breakdowns coming. Now, back to BlackRock. That same base explains the biggest structural bet in the company's history, and it started, oddly, with a government phone call. During the 2008 financial crisis, regulators needed someone who actually understood the mortgage-backed securities poisoning the banking system. Those same instruments Fink's old desk had once helped build. They hired BlackRock to help manage troubled assets from Bear Stearns and the insurer AIG. That credibility was still fresh in June 2009 when BlackRock agreed to buy Barclays Global Investors, the British bank's asset management arm, for $13.5 billion, paid partly in cash and partly in 37.8 million new BlackRock shares. Buried inside that purchase was a smaller unit called iShares, then a growing but secondary line of exchange-traded funds. The deal doubled BlackRock's assets to roughly $2.7 trillion overnight, and almost as a side effect, made it the largest ETF provider on Earth. Barclays walked away holding nearly a fifth of BlackRock's own stock, a position it sold down within a few years. BlackRock had entered the deal to buy scale in bond management. It left owning the future of passive investing. The government trusted the company again in March 2020, hiring it, without a competitive bid, to run the Federal Reserve's emergency corporate bond and ETF purchase programs during the pandemic, an arrangement critics noted could let BlackRock end up buying its own ETF products with public money. That future came with a problem baked into its own success. The fee on an index fund can only fall,
never rise, because the entire pitch is that BlackRock isn't smarter than the market, just cheaper to access. Once IVV's fee reached 3 basis points, there was nowhere left to cut without losing money outright. So, over roughly the past 2 years, BlackRock has spent about $28 billion buying its way into a part of the business where fees haven't been competed down to nothing: private markets. It bought Global Infrastructure Partners, an owner of ports, pipelines, and power plants. It bought HPS Investment Partners, a private credit lender. It bought Preqin, a data firm that maps the private markets industry itself. None of those businesses charge 3 basis points. Private credit and infrastructure funds typically charge management fees several times higher than an index fund, plus a cut of the profits when the investments do well. In the second quarter of 2026 alone, BlackRock's private markets businesses pulled in over $15 billion of fresh client money, $5 billion into infrastructure, and $6 billion into private credit. The index business built BlackRock's scale. The alternatives business is where that scale is now being spent.
Nowhere is that shift more visible than in a deal that has nothing to do with stocks or bonds at all. In March 2025, a consortium built around BlackRock's new infrastructure arm agreed to pay roughly $22.8 billion for control of 43 ports in 23 countries, including the terminals at both ends of the Panama Canal, after the Trump administration alleged Chinese influence over the waterway. The deal instantly became a geopolitical event rather than a financial one. Beijing's market regulator opened an antitrust review. China's state shipping giant COSCO was invited into the buying group to smooth the politics, then reportedly demanded a majority stake of its own, a demand the consortium has resisted. By early 2026, the sale still hadn't closed, and Panama's courts had annulled the seller's original port contracts, handing interim control of the canal terminals to 2 shipping companies instead. Whatever the final outcome, the episode shows what BlackRock's pivot into infrastructure means in practice. A company that once mostly held paper claims on other businesses now sometimes holds the physical choke points of global trade directly. That expanding footprint feeds a tension that has followed BlackRock from both political directions at once. In 2021, Texas passed a law requiring the state's pension funds to divest from any financial firm found to be boycotting the fossil fuel industry. In 2022, the state put BlackRock on that list over its membership in a climate coalition called Climate Action 100+. By March 2024, the Texas Permanent School Fund had pulled $8.5 billion from BlackRock, the largest divestment of its kind by a Republican-led fund, while Florida, Missouri, and West Virginia pulled billions more. BlackRock has denied boycotting energy companies and noted it still held roughly $400 billion of Texas-related investments. It also began quietly retreating from the climate coalitions that triggered the fight, exiting several of them, and in June 2025, Texas removed BlackRock from its list, one of only 2 firms ever taken off it. The scrutiny didn't end there. Texas's Attorney General has since sued BlackRock, along with rivals State Street and Vanguard, alleging the 3 ran what the complaint calls an investment cartel that bought coal company shares to suppress production, a claim the companies dispute and that remains unresolved in court. Underneath the political fight sits an older, quieter concern. Because BlackRock and its 2 largest rivals dominate index investing, they collectively cast something like a quarter of all votes at S&P 500 annual meetings, and BlackRock alone holds 5% or more of nearly every company in that index, not by choosing individual targets, but simply by owning the market. Legal scholars have described this concentration of unelected voting power as the problem of 12, the idea that a handful of firms could end up with practical influence over most of corporate America without ever buying a controlling stake in any single company. BlackRock's response, a program it calls Voting Choice, lets institutional and increasingly individual fund holders direct their own votes instead of leaving the decision to BlackRock. Within about a year of launching it, roughly a quarter of eligible assets had opted in.
It is a real transfer of power, and it is also, not incidentally, the cheapest way for BlackRock to answer a threat to the same business model that made it this large in the first place. None of this is easy to copy. A new entrant can cut its own index fund fees to nearly zero, and some already have, but it can't buy 30 decades of Aladdin's accumulated code or the trust of the pension funds and central banks already running their books on it. A traditional stock-picking rival can try to build a private markets arm, but not for $28 billion in 2 years without BlackRock's existing scale to borrow against.
A pure technology company could theoretically build something like Aladdin from scratch, but it would need trillions of dollars of real client assets flowing through it first, because the product only works if the data behind it is real, not simulated. And no challenger arrives with BlackRock's decades-long history of being the firm regulators and central banks already call when markets break, a relationship that took a genuine crisis, not a marketing budget, to build. Scale bought the software. The software now defends the scale. Trust in a crisis defends both. That loop is the moat. Next time you check a retirement account and see a fund with iShares in the name, remember what you're actually looking at. You are not paying for someone to beat the market. You're paying in the smallest possible increment for the machine that runs the market. And that machine is also the one deciding on your behalf, unless you say otherwise, who sits on the boards of the companies you own. That arrangement holds as long as two things stay true: that BlackRock's technology keeps being cheaper to rent than to rebuild, and that the public keeps accepting a small number of firms holding that much default power quietly. Weaken either one, and the machine that looks unshakable today starts looking like exactly what it is: a bet that scale and trust can substitute for scrutiny indefinitely. BlackRock's own stock trades on the New York Stock Exchange, which means it sits right now inside the same index funds, its own and its rivals, that this entire machine was built to hold. There's a written business guide linked in the description if you want this broken down further. If this helped you see how the machine actually works, like the video and subscribe to Terminal Value. Thanks for watching.